The S&P 500 isn't a diversified index anymore. It's a concentrated growth fund. About 35% of your money goes into just about 7 companies. And if you're treating it as a low risk buy and hold investment, you could be running on borrowed time. So what's the setup for the next decade? It looks historically challenged. And I think there's a better way to think about this. Hi, I'm John Cervantes, Chartered Financial Analyst. And this is the Practitioner's Brief. In 2026, we're going back to basics. A new series where we cut through the noise and focus on what actually matters. Over the next few posts, I'm going to walk through how I'm thinking about 2026. No price targets, no predictions, just strategy and frameworks that can guide real decision making. Today, we're covering equities, specifically why the S&P 500 may not be the safe bet everyone assumes, and where I see better opportunities. Since I began publishing the Practitioner's Brief in the fall of 2025, I had a few key messages. Don't get over your skis on your AI exposure. The Mag 7 have a difficult setup. A market rotation was beginning from the Mag 7 to the remaining S&P 493 and into small caps. And last, midterms would drive political pressure to take action on consumer cost and housing. So where did all this end up landing? Since the beginning of the fourth quarter in 2025, small caps and the average stock represented by the equally weighted S&P 500 have outperformed both traditional market cap weighted S&P and the Mag 7. On housing, my views have been a bit mixed. The president instructed Fannie Mae and Freddie Mac to purchase mortgage-backed securities, just like I wrote about. But the 10-year Treasury has actually moved higher, not lower. The rotation thesis is playing out, but the housing thesis is still to be determined. Here's a framework for 2026. It's all about starting points. Forget the price targets in the forecast. They're a fun exercise, but they don't provide much real value. What matters is understanding where we're starting from, because starting valuations are the primary driver of long-term returns. It's not just my opinion, it's decades of market history. Buy at high valuations, expect lower returns. Buy at low valuations, expect higher returns. And right now we're starting at one of the highest points in history. So what's my issue with the S&P 500? It's become a concentrated bet on 7 technology companies, 35% of the index, 7 names. When you buy the market, you're not getting broad diversification. You're primarily getting Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, with 493 other companies along for the ride. Here's the problem. The SAFE index now looks more like a concentrated growth fund. Now, I just used the term market cap weighted and equally weighted, and I'm not so sure everyone knows what that means. So let's take a quick side quest. When most people say I own the S&P 500, they're talking about a market capitalization weighted index. That's the S&P. That's a default. Market cap is just the share price times the shares outstanding. That equals the total value of a company. Nvidia's market cap is about 4.6 trillion. To contrast, SanDisk is around 85 billion. So Nvidia is about 50 times larger than SanDisk. In a market cap weighted index, your investment is proportional to size. Nvidia is 8% of the index. 8% of your money goes in Nvidia. SanDisk is 0.14% of the index. SanDisk is also one of the best performing stocks this year, but it just doesn't matter due to its size. Equally weighting flips this. Every company gets the same allocation. Invest $100, each company gets 20 cents. Apple gets the same as Dollar General. Why does this matter? 1, concentration risk. In market cap weight, if the Mag 7 struggle, your diversified portfolio struggles. 2, rebalancing discipline. Equally weighted indexes rebalance quarterly. Selling winners, buying laggards, buy low, sell high, built right into the methodology. 3, real economy exposure. Equally weighted index gives you more industrials, financials, healthcare, materials, not just big tech. Here's where it gets interesting. The equal weight also underweights disruptive technology. So the point is not to shift into the equal weight S&P, it is to use this information to guide our decision making and our investment efforts. These two measures of the S&P have historically been tied at the hip, vibing generally in the same direction. And since there's this big divergence of this magnitude, we have to take a step back and use this to help guide our decision making and also our security selection. It's largely about position sizing. So where do the low return expectations come from for the S&P? My favorite long-term valuation metric is a chart highlighted by BofA Research showing 10-year annualized return projections based on current valuations. The S&P 500 market cap, the one everybody owns, it's about negative 1% per year in price return over the next decade. The equally weighted S&P 500, positive about 6% per year. That's a 7 percentage point annual gap. Same 500 companies, just different weighting methodology. It's a dramatically different expected outcome. How do they come about these numbers? It comes from the normalized price to earnings ratio. A regular price to earnings ratio tells you how much you're paying for current earnings. But current earnings can be misleading, inflated one year or depressed the next. Normalized PE smooths this out. It takes today's price divided by 10 years of average earnings. And here's what the data shows. There's a strong relationship between starting normalized price to earnings and your returns over the next 10 years. Buy at high valuations, get lower returns. Buy at low valuations, get higher returns. It's not a crystal ball, but the correlation is remarkably consistent. Across market history, it explains about 80% of the forward return. So valuation doesn't matter in the short term, but it's about all that matters in the long term. And right now, the S&P 500's normalized PE is in the top decile of all historical readings. We're paying a premium price, and historically, premium prices deliver subpar returns. The equally weighted index just trades at a much more reasonable valuation. So why are valuations so stretched? Corporate profit margins historically revert to the mean. They expand, they contract, but the Mag 7 has defied this. They've been asset-light businesses with little to no antitrust pressure. Microsoft doesn't need factories, doesn't need inventory. Meta's marginal cost per user is nearly zero. So they generated enormous profits without proportional capital investment. But this cycle has begun to change. They're spending record amounts, data centers, custom chips, electricity contracts. The question becomes, will these investments lead to margin expansion, or are they just table stakes necessary to compete, but not sufficient enough to drive excess profit? For investors approaching retirement, the uncertainty is this risk. We don't know how returns will unfold. If we do have a low to negative return period, how does this shake out? A 2000 style grind, a 2008 style crash, some just sideways painful years? Here's my strategic direction. I don't need to own all of the Mag 7. I can be selective. And there's more opportunity in other market segments tied to the real economy, not just in the AI arms race. While my skeptical views on the AI technology might have been contrarian, now I think the consensus is starting to shift my way. Michael Burry put it perfectly, this echoes my opinion. He was featured on Dwarkesh Patel's Substack, and Burry said Warren Buffett owned a department store in the late 1960s. When the department store across the street put an escalator in, he had to too. In the end, neither benefited from that expensive project, no durable margin improvement or cost improvement, and both were in the exact same spot. This is how AI implementation will play out, end quote. I think he's right. The primary beneficiaries of AI will be consumers and small businesses through increased competition and lower prices, not necessarily the companies spending billions on infrastructure. Here's the first real-world example. January 21st, Lemonade announced insurance for self-driving Teslas that cuts rates by 50% for full self-driving engaged driving. So this is just the first example, and I'm sure there'll be many to come. For the S&P 500 to deliver strong returns, AI needs to produce sustainable margin expansion for the Mag 7. But these companies are now competing against each other. Amazon and Google building their own chips to compete with NVIDIA for specific workloads. And even with the technology itself, Ilya Sutskever, the co-founder of OpenAI, was quoted in a recent interview, "We're moving from the age of scaling to the age of research." And my take on this was AGI is not going to come from scaling large language models. The holy grail of artificial general intelligence is getting pushed further out. So the present value of those benefits, it hurts the current AI thesis. This used to be a fringe view. It's now becoming a little bit more mainstream. So what key trend am I watching that perfectly frames the AI debate? It's the divergence between software stocks and semiconductors. Investors are buying semiconductor stocks, the picks and shovels of the AI infrastructure, while selling legacy software businesses. Why? They're beginning to question the terminal value of software. Here's a quick explanation. When you're valuing a company, you're paying for all the future cash flows. Terminal value represents cash flows far into the future, typically represents a majority of the value of what you're paying for a stock today. When investors believe a business might not exist in its current form in 10 or 15 years, terminal value shrinks and the stock falls even if current earnings are fine. And according to recent earnings reports, most of the software stocks look fine. The best way I think about this is looking at GM and Ford. Decent cash flow today, but they trade at rock bottom valuations. Why? Because the market's saying you're making money now, but you may not be around, at least in your current form, a decade from now. And this could be starting in software. If AI allows companies to build their own solutions instead of licensing from Adobe, Salesforce, ServiceNow, the terminal values compress. The market doesn't need to believe these companies will go bankrupt. It just needs to assume that they're going to be worth a lot less in the future. And this is a technology debate playing out in real time. Can AI drive down the cost of software development? Can it be produced reliably, secure, customized solutions internally, free from security vulnerabilities and hallucinations? And right now, the market is beginning to say yes. I'm skeptical here. I think investment opportunities will develop, but in my experience, the trend is firmly in place, and I think it's too soon to fight this tape. Let me tie this together. The S&P 500 is concentrated in 7 companies at historically high valuations. Those companies are spending unprecedented amounts on AI, and the market's starting to question whether it will expand margins or just become table stakes. Normalized price to earnings data suggests the market cap weighted S&P could deliver negative returns over the next decade. Equally weighted, same companies, different methodology, is projected to deliver 6% annually. A rotation has begun. Money is moving to the other 493 stocks and into small caps and into the real economy. In software, terminal values are being repriced as investors ask whether these businesses will exist in their current form. So just keep in mind, starting points matter. And right now, the starting point for America's most popular investment is historically challenged. What does this mean for you? If you're accumulating wealth, time is on your side, but you can't just assume the S&P 500 is set it and forget it. Understand that owning the market today means a concentrated bet on 7 technology stocks at peak valuations. If you're transitioning to retirement, the sequence of return risk is real. 3 bad years in retirement can really hurt and dent your plan, so you have to be stress tested. Remember, in 2022, many large cap tech stocks were down over 50%. So starting points matter, and now you have a framework. That's the first installment of Back to Basics. Next in this series, we're going to ask, what do we do with bonds in 2026? Remember, this is broad education. It's not individualized advice. Seek out a qualified professional. Thanks for watching. I'll see you in the next brief.